Current economic instability, a foreshadowing of challenges Americans will soon face. Introduction. For decades, the American economy was seen as a symbol of strength, a place where hard work led to opportunity, where stability felt achievable, and where the future, while uncertain, still felt hopeful. But today, that confidence is fading. Inflation is eating away at paychecks. Interest rates are rising at historic speeds. Housing has become unaffordable for millions, and the labor market is shifting faster than many people can adapt. Some say these challenges are temporary, that the economy will stabilize, that things will return to normal. But many economists, analysts, and everyday Americans feel something different. They sense that the instability we see today is not just a rough patch. It is a warning, a signal that deeper, more persistent economic challenges may be approaching. In this video, we're going to explore the current state of economic instability in the United States. We'll break down what's causing it, why it matters, and how these forces could shape the lives of millions of Americans in the near future. Part 1. A nation under economic pressure. The U.S. economy is under strain from multiple directions at once. Some of these pressures are familiar, others are new, and many are happening simultaneously. This combination is what makes the current moment so fragile. Soaring inflation and the cost of living. Inflation has reshaped daily life for Americans. Groceries cost more. Gas prices swing unpredictably. Rent keeps rising. Utilities are more expensive. Even small purchases feel heavier than they did just a few years ago. Inflation reached levels not seen in over 40 years. While the rate of increase has slowed at times, prices remain high. And once prices rise, they rarely fall back down. That means households are permanently paying more for basic necessities. For middle and lower income families, this is especially painful. Budgets are stretched thin. Savings disappear quickly. Emergency expenses become financial disasters. To fight inflation, the Federal Reserve has raised interest rates aggressively. The goal is to slow spending and cool the economy. But this solution comes with trade-offs. Higher interest rates increase the cost of borrowing. Mortgages become more expensive. Car payments rise. Credit card balances grow faster. As borrowing costs increase, people spend less. Businesses slow investment. Growth decelerates. The fight against inflation, while necessary, adds another layer of instability to an already fragile economy. The housing market breakdown. Housing is one of the clearest signs that something is wrong. Home prices surged dramatically over the past several years. Low interest rates, limited supply, and heavy investment demand pushed prices far beyond what many Americans could afford. The pandemic accelerated this trend. Remote work allowed people to move away from cities. Demand surged in suburban and rural areas. Prices followed. Now, interest rates are rising sharply. Monthly mortgage payments have jumped. First-time homebuyers are locked out. Renters face steep increases with little relief. Affordable housing is becoming increasingly rare. This matters because housing has traditionally been one of the primary ways Americans build wealth. When fewer people can buy homes, wealth inequality grows, and long-term financial security weakens. The housing crisis is not just about shelter. It's about opportunity. And right now, that opportunity is shrinking. Rising interest rates and growing debt. Debt is another major pressure point. American households carry record levels of debt. Student loans, credit cards, auto loans, and mortgages weigh heavily on budgets. As interest rates rise, servicing that debt becomes more expensive. Minimum payments increase. Balances grow faster. Savings shrink. Many families are living paycheck to paycheck. One unexpected expense can trigger financial crisis. This creates vulnerability across the economy. If unemployment rises or wages stagnate, defaults become more likely. Bankruptcies increase. Foreclosures return. Debt doesn't just hurt individuals. It weakens consumer confidence and slows economic momentum. Fragile global supply chains. The modern economy depends on global supply chains, and those supply chains are fragile. The COVID-19 pandemic exposed how quickly disruptions can ripple across the world. Factory shutdowns, shipping delays, labor shortages, and logistical bottlenecks caused shortages and price increases. Even after the pandemic eased, disruptions continued. Geopolitical tensions, trade disputes, and conflicts like Russia's invasion of Ukraine have added new risks, especially in energy and food markets. These disruptions raise costs for businesses and consumers alike. They fuel inflation and increase uncertainty. The U.S. remains vulnerable to future shocks, making economic stability harder to maintain. Part 2. Deeper issues beneath the surface. While these immediate pressures are serious, the real concern lies beneath them. The current instability is revealing deeper structural problems that have been building for decades. The expansion of wealth inequality. Wealth inequality in the United States has been growing for a long time, and today's economic conditions are accelerating that trend. Those who own assets, stocks, real estate, and businesses have been better positioned to weather inflation and volatility. Asset values often rise alongside inflation, protecting wealth. But most Americans rely primarily on wages, and wages have not kept pace with rising costs. The result is a widening gap between those who own and those who work. The pandemic made this divide even clearer. Higher-income workers were more likely to work remotely, save money, and invest. Lower-income workers faced layoffs, health risks, and financial instability. As inflation continues to erode purchasing power, inequality is likely to deepen. This level of inequality does more than strain finances. It fuels frustration, resentment, and social tension. The slow collapse of the middle class. The middle class has long been the backbone of the American economy, but that backbone is weakening. Rising costs combined with stagnant wages are pushing more families toward financial insecurity. Saving for retirement, education, or emergencies is becoming increasingly difficult. Healthcare costs rise, housing costs rise, education costs rise. To keep up, many families rely on debt. Over time, this erodes stability. As the middle class shrinks, consumer spending weakens. Economic resilience declines. The economy becomes more vulnerable to shocks. A hollowed-out middle class is a warning sign for long-term instability. A labor market in transition. The labor market is changing rapidly. Automation, artificial intelligence, globalization, and demographic shifts are reshaping how work is done. Some jobs disappear. Others become less stable. Many offer fewer benefits. While unemployment numbers may look strong, job quality tells a different story. More workers are in part-time, contract, or gig roles. These jobs often lack security, healthcare, and predictable income. The Great Resignation highlighted widespread dissatisfaction with wages, working conditions, and limited advancement opportunities. As more Americans struggle to find stable, well-paying work, economic anxiety increases. A workforce under constant stress cannot support long-term stability. The growing debt crisis. Debt may be the most serious long-term risk. The U.S. national debt has surpassed $30 trillion and continues to grow. At the same time, consumer debt is at record levels. As interest rates rise, debt becomes harder to manage for both households and the government. High debt limits flexibility. It reduces the ability to respond to future crises. It increases the risk of financial instability. Debt also affects psychology. When people feel trapped by financial obligations, confidence drops, spending slows, economic momentum weakens. Part 3. What Americans are likely to experience. As these pressures continue, many Americans should expect sustained financial strain. Housing will remain expensive. Living costs will stay elevated. Debt burdens will grow heavier. If the Federal Reserve continues raising rates to fight inflation, economic growth may slow further. That increases the risk of recession. A recession combined with high inequality, weak job security, and heavy debt could be especially painful. For those without savings or assets, even minor disruptions could become life-changing crises. The stress will not be evenly distributed. Lower-income and middle-class Americans will feel the impact first and hardest. Part 4. Why this moment matters. This period of instability is more than an economic phase. It is a turning point. The choices made now by policymakers, businesses, and households will shape the economic landscape for years to come. Ignoring the warning signs could allow small problems to become major crises. Addressing inequality, strengthening job security, managing debt responsibly, and investing in long-term stability will be essential. Economic systems are not fixed. They are shaped by decisions. Conclusion. The economic instability we see today is not just a temporary disruption. It is a signal. Rising inflation, an unaffordable housing market, growing debt, widening inequality, and a labor market in transition. Together, these forces point toward a more challenging future. How severe that future becomes depends on awareness, preparation, and action. Understanding these warning signs now gives Americans a chance to adapt. The road ahead may be difficult, but recognizing the risks is the first step toward resilience. And in uncertain times, awareness matters more than ever.